Hidden riches, unmasking the elusive techniques of tax evasion and wealth concealment. If I told you that Warren Buffett pays less in taxes than his secretary, you might wonder why a billionaire pays fewer taxes than an average secretary who earns a regular income. The reason is that there are two types of taxpayers: those who accept taxes as a natural part of life and pay what the government requires, and those who do everything that they can to avoid paying taxes. Let's give these two types of people names. We'll call the first type Paul and the second type Jack. When the government comes asking for taxes at the end of the year, it doesn't seem like a big deal. Paul earns $40,000 a year, and he hands over his $15,000 in income taxes without too much fuss. While he'd like to keep more of that $15,000, he sees paying taxes as a regular part of life. Jack, in contrast, is a medium-sized business owner who started and built his tech company from the ground up. With over 50 employees and consistent year-over-year growth, Jack has a different perspective on taxes. He strongly dislikes them and questions why the government, which didn't contribute to his business's success, should take such a significant portion of his hard-earned money. To make matters worse, Jack faces multiple forms of taxation, including personal income tax, sales tax, excise tax, property tax, and investment tax, both on his personal income and his business. Frustrated by the tax burden and inspired by reports that large corporations like Amazon paid no income tax in 2018 despite enormous revenues, Jack decided to explore how big businesses avoid paying taxes. Determined to keep more of his earnings, he sought ways to reduce his company's corporate tax liability and lower his personal tax bill. In his search for tax-saving strategies, Jack discovered the following techniques. One effective method to reduce taxes is by deducting expenses, especially for individuals who have built their wealth through businesses. This opportunity allows them to offset their taxable income. In essence, many of the day-to-day costs associated with running a business can be subtracted from the earnings, ultimately lowering the amount subject to taxation. Here's an example to illustrate this. Imagine you operate a digital marketing agency and generate $200,000 in annual revenues. If you had no expenses, the entire $200,000 would be subject to taxes. However, most businesses incur various expenses which can significantly reduce the taxable profit. For instance, if you have $100,000 in legitimate business expenses each year, your annual profit for tax purposes would be $100,000 instead of the full $200,000 in revenue. This substantial reduction in taxable income results in paying less in taxes. Eligible expenses can encompass a wide range of items such as business-related meals, office supplies, new laptops, internet costs, employee benefits, staff training, rent or lease payments, and even expenses related to company vehicles. Moreover, as a business owner, if you decide to attend a conference to enhance your skills in digital marketing, you can often deduct this expense as well. It's worth noting that this tax reduction method primarily benefits business owners. This is one of the reasons why many individuals who own and operate businesses appear to be wealthier than those who work as employees. Another method for reducing taxes is by diverting income to countries with lower tax rates. In 2017, the United States reduced its corporate income tax rate from 35% to 21%. While this reduction benefited many companies, some, like Amazon, still choose to report their income in countries with even lower tax rates. For instance, the Cayman Islands is a well-known tax haven with no income tax, corporate tax, estate or inheritance tax, gift tax, or capital gains tax. In simple terms, any income earned there remains untouched by taxes. This can lead to substantial savings for businesses. Here's an example to illustrate the potential savings. Suppose your business earned $5 million last year. If you were subject to the US income tax rate of 35%, you would owe $1,750,000 in income taxes. However, by diverting your income to a tax haven like the Cayman Islands, you would pay nothing in income taxes, allowing you to keep nearly $2 million for yourself. Additionally, the Cayman Islands boasts strict banking laws designed to safeguard banking privacy. They lack tax treaties with other nations, protecting the finances of offshore banking clients from tax authorities in other countries. Furthermore, offshore corporations established in the Caymans are not obligated to submit financial reports to any Cayman government authority. The incorporation process in the Cayman Islands is also straightforward and efficient. Given all these benefits, it's not surprising that many companies are choosing these remote destinations to shield their earnings from high taxation. Method 3 involves comparing the money a business business makes with the money it loses. When you look at the statistics about starting a business, you'll see that they can be pretty discouraging. The numbers show that 20% of small businesses fail in their first year, 30% in the second year, and 50% after 5 years. Surprisingly, even after 10 years, 70% of small business owners fail. Despite these low success rates, some companies do well and make a lot of money. To protect their earnings, they use something called loss carry-forwards. Most businesses don't start making a profit right away, and during the early years, they often have losses. These losses, while unfortunate, can actually help with taxes in the future. Similar to expenses, businesses can subtract these loss carry-forwards from their earnings to reduce the amount of taxes they have to pay. This means they keep more of their income instead of giving it all to taxes. Method number 4 is all about giving stock options to people who have a stake in a business. This helps businesses lower their taxes for two main reasons. First, it's counted as an expense, which lowers the profits that are taxed. Second, it doesn't involve actually giving out cash. When a business issues stocks this way, it's considered an expense for accounting purposes, but no money changes hands. This allows the company to reduce its taxable profits and keep a strong cash position. Additionally, companies using this strategy benefit from motivating their shareholders to increase the stock price. If you own stock in the company you work for, you'd probably work harder to make the stock's value go up, right? That way, you can cash in your options for more money. With these 4 corporate tax strategies in mind, Jack is feeling more confident about reducing or even eliminating his business's tax bill. However, he also needs to take some money from his business for personal expenses, and he wants to minimize the taxes on that income. So, he's shifting his focus to finding ways to lower his personal tax payments. Method number 5 is about using the tax laws in different locations to your advantage. Jack has been running his business in Silicon Valley for 20 years, but he's fed up with the sky-high state income tax rate there, which is 13.3% for top earners. He feels like he's losing a big part of his income to the state and federal governments in taxes. While he can't avoid federal taxes, he's looking for ways to reduce some of the other taxes he's paying. Jack started researching states with lower income tax rates and was pleasantly surprised to find 7 states with no income tax like Texas, Nevada, and Florida. This means he could save the 13.3% tax he's currently paying and still enjoy sunny weather all year long. As he explores housing options in these states, he's also thinking about other ways to lower his personal tax bill. Method number 6 is about investing in real estate, and it's one way the wealthy keep getting wealthier. They put their money to work for them by owning properties. This not only boosts their wealth through rental income, but also helps them pay less in taxes. When you buy a property, it's considered a depreciable asset. Over time, its value decreases for accounting purposes, which allows you to deduct depreciation and lower the taxable income. You can also deduct expenses like property repairs and mortgage interest. The more you spend on these expenses, the less tax you have to pay. But what happens when a property is fully depreciated? You can sell it and buy a new one. While selling a property usually triggers taxes, there's something called a 1031 exchange. It lets you defer the tax if you buy a new property within 60 days of selling the old one. Essentially, you can keep buying and selling properties never paying the tax while still making rental income from them. Method number 7 is about deferring income, which Jack is considering even after exploring options like moving to another state and using real estate to lower his taxes. A common way to do this is by using an individual retirement account or IRA. With an IRA, you can put your income into a fund and delay paying taxes on it until a later date. Many people use IRAs to save for retirement, but they're also a smart tax saving strategy. Here's how it works. If you're an employee, you can contribute money to your IRA, and the amount you contribute gets deducted from your taxable income for that year. This is especially helpful for high earners because it lowers their tax bill during their peak earning years. For example, if you make $500,000 a year and are in a high tax bracket, you might be paying up to 40% in taxes. But with an IRA, you can defer some of that tax and potentially pay only 20% when you withdraw the funds in retirement. During retirement, your income is likely to be lower, so you'll pay taxes at a lower rate. The difference in tax rates is how much you save by using this income deferral method. With all these tax-saving strategies, you have to decide whether you'll be more like a savvy tax planner or someone who pays higher taxes. It's a choice you can make to protect your wealth. Thank you for watching, and we'll see you in the next video. Stash Cash signing off.